Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. Today, we're diving into a proxy statement from ServiceNow. Now, a proxy statement might sound about as thrilling as watching paint dry, but trust me, there are always a few juicy details buried in there, especially when it comes to how much executives are getting paid. This document is essentially ServiceNow's invitation to its shareholders for the annual meeting in May. It outlines what they'll be voting on, who the nominees for the board are, and some other governance stuff. We're going to break it down to see what's really going on. Let's start with the good stuff. ServiceNow is boasting about its strong growth and profitability. Subscription revenues are up a solid 23%, and they're keeping customers happy, seeing a 98% renewal rate. Their 5-year shareholder return is smoking the S&P 500 and their peer group. That's good news. You want to see that return on investment really shine. Now let's look at who they want you to elect to the board. They've got 9 nominees, highlighting their experience. Most have senior leadership experience, but they all check different boxes like risk management, financial savvy, and knowledge of emerging technologies. Makes sense. You want board members that aren't all the same, that provide a wide array of useful feedback. Now we get to the real tea, the executive compensation. ServiceNow emphasizes its pay-for-performance philosophy. What this usually means is that a big chunk of their pay is tied to how well the company does. Their annual cash incentives for 2024 paid out just under target, despite a killer year. This shows they were very rigorous targets. This is exactly what you want to see. Compensation linked to company performance. Time to look at what they are voting on, Kims. First up is the election of directors, which we briefly touched on. The board recommends voting for all their nominees. Then there's the say on pay vote. This is where shareholders get to give a thumbs up or thumbs down to the executive compensation packages. The board, of course, wants you to vote for it. Next, they want you to ratify their pick for independent auditor PricewaterhouseCoopers LLP, POC. Again, the board is on board, urging you to vote for. Then comes the important stuff where the company wants to amend some legal stuff in their charter, basically allowing officers to avoid personal financial ruin when acting honestly and in their company's interest. Board is all, obviously. Then the board wants to drop a supermajority voting structure, where some things needed 66% of the vote and drop it to 51%. They are for dropping it. After all that, they have to vote on shareholders' proposals. Shareholders want to change the nomination bylaws to guarantee the right to cure any apparent nomination defects. The board is voting against that change. Finally, shareholders want to remove the requirement to hold shares for a year before calling a special meeting. Again, the board is voting against this as well. Here's what I see as the big picture. ServiceNow is trying to present a picture of strong growth, solid governance, and executive pay that's tied to performance. What I found interesting is that ServiceNow seems very sensitive to what its shareholders think, and this sensitivity is mostly motivated by past issues. It looks like they got only 41% approval on their say on pay in 2023, which prompted some big changes, and they tout their approval being 88% for 2024 as a badge of honor. What was interesting though is that they seem very reluctant to enact any of the shareholder proposals in this report, but hey, it's advisory. Scroll 23, cash subscription. Revenues growth, while their growth has been fantastic at 23%. Keeping the current customer base is essential as well, and it seems like that part is not up for negotiation. The board seems to want to protect against outside agitators coming in, calling a vote, and leaving shortly afterwards, which in theory can have disastrous consequences for a company. As Warren Buffett always says, you need a moat, and sometimes those moats come in the form of bylaws. But here is a bit of a red flag. The old president and chief operating officer dipped mid-year and they needed to bring someone else in. While that new person is definitely qualified, these executive positions are never just about qualifications. It's about people fitting in. So what's the overall verdict? ServiceNow is in a strong position, showing good growth, and appears to be responsive to shareholder concerns. However, the executive shuffle and strong rejection of outside shareholder proposals indicate potential internal friction, and overconfidence is always something to keep an eye on. Thanks for watching. If you found this breakdown useful, hit that like button, leave a comment, and subscribe for more corporate deep dives.